Introducing my new a third portfolio. I've come to the conclusion this is how I want my portfolio to be. We'll dive into this here today, right now. Don't forget, Tuesday, along these lines, Craig Israelson will be back to join us live Tuesday at 8 to talk about his findings on the same stuff we're talking about in terms of his 712 portfolio. I'm not so sure I want to be that delicate on it. I like simplicity, frankly. And so for me, it's going to be VTI, BND, and cash. And I'll show you what I'm talking about here in just a second. That doesn't mean I won't add various things on occasion, but and that's going to be the bulk of my portfolio. I think we'll hold the line mode. Hold the line mode. And the reason I think that's, I just don't know where the earnings growth is going to come from to replicate the last 12 years we've had. I don't know. People say automation, maybe. It's kind of like people say with batteries, we're going to have batteries. We can just use the sun for solar. And we're still using lead acid batteries, man. It's insanity. It's people want to believe. It doesn't mean it's going to come reality. I think protection mode is most important, man. The moat. Now, that doesn't mean you put it all in the cash, because I still think there are growing dividend opportunities in stocks, 100%. I don't know which stocks those are. I own Southern Company. I own a couple other individual dividend paying. I don't know. You don't know. But I do know at the end of the day, I think just a broad market index with growth and dividends, and just growth generally speaking, is the way to go for your stocks. I've been thinking about this a lot. And I can't come to a better conclusion, man. Because I don't know where the growth is going to come. And if it does come on some stocks, like we've seen Apple, I think Apple and a couple others are basically the bulk of the S&P 500 growth. So, I mean, I want to be there. If it has some of that, absolutely. But I also want to be there to protect it if it doesn't come to that. And I think that's a likelihood as well. I just don't know. So let me show you what I've been doing here. So this is, hold on a second. Can I find it? I guess I don't have it up here right now. Anyway, this is my man Ed McQuarrie. When do corporate bond investors earn a premium for bearing risk? That's not what I was actually reading. I guess I have it. Yeah, right here. So it's my man Ed's article. Can the huge advantage of stocks over bonds piled up between 1946 and 1968 ever be diluted away? And as a student of the market history, histoire, as we like to say. Oh, don't forget, subscribe to my locals channel. Once every Friday at 4 p.m. Eastern time, last night at 7 p.m. Eastern time, we go live. All right, $5 a month to subscribe. You can contribute. You can access stuff. It's just, I love it, man. It's a little community. I'm a big fan. So locals channel and my retirement planning course, the last week on sale. So go to the retirement planning course. I'll put in the doobie-doo and use promo code or coupon code. They call it coupon code TAX, T-A-X, 50% off. Dude, I've sold, I can't remember, I sold a bunch of these courses. I've only had 10 refunds. I've sold well over, I don't even know how many. 1,000, something like that? I mean, it's crazy. I've only had 10 refunds. You get a 30-day free look. Friggin' buy the course, man. It's great. I'm so proud of it. And you'll be too. And if you don't like it, get your money back. I don't care. I doubt you will, because most people don't. The vast. All right, so anyway. So along these lines, I come up with this guy, the professor over at, and I always get nervous just relying on one guy. You know what I'm saying? So this is, I forgot this guy's name, but NYU. I don't know what it's called. Stern University or something. I don't know. Don't care. A professor at NYU. He's got annual returns starting in 1928. And I was looking for a U.S. Treasury bonds. He's got T-bill stocks, T-bonds. And it's like, and I'm using his numbers in this regard. I think they're probably right, but I can't validate this, and this always bothers me, man. I actually went to newspapers.com. I went to Wall Street Journal because I own, or New York Times business section to see if there's any kind of semblance of histoire where we can look back and say, what did bonds do? And I spent a couple days looking at this. It's not that easy to find. So I'm going to rely on this guy. Other people that I follow rely on this guy, but I always get nervous. Like, where's his data from? And I don't see any links that says this is where his data is from. Like with Schiller and all this stuff, we tend to rely on these professors and hope that they, as if they got all the data right. I think there's some reason to suggest it's correct because we always know 2000, 2001, and 2, the S&P 500 was down 9, 11, and 12, and 22%. So if we can see that right here in his S&P 500, 9, 11, 9, 12, and 22%. Then we know at least that number's right. I'm okay with that. But in 94, the bonds should have been down. Yep, 94 bonds down. 99, the bonds were basically down too. So I'm pretty comfortable with what this guy's saying here. That's the bonds right here. 94 right here. 94, right there. 99, right there. Yeah. So bonds. Yeah, right there. So 94, 99. So I'm giving it the benefit of the doubt, which makes me very, very cautious. Not that it would change my perspective at all. I just I don't trust any of these guys. There's no other way around that. And none of these guys anymore. I don't trust. You shouldn't either. You should always validate. Trust but verify. Is that what Reagan used to say? Yeah, I try to verify and I can't. And I'm not going to spend oodles and oodles more time on this. So I'm just going to go with it. But always makes me nervous. All right. So anyway, so I'm taking this data and I'm just coming over here. I'm putting my own little spreadsheet here, my own little Josh mix to it. And so basically going back to Ed's stuff. Ed says from 46 to 68, the bond market just got skunked by stocks. And as we're going to see down here, we're going to see exactly what Ed's talking about. So we're going to see from 46 to 68, S&P 500 averaged 14% a year. This is 3 month average 2.5. And essentially, I don't even know what the bond. I emailed the guy. I wouldn't expect him to email me back. But the bond was, we're going to just say, essentially the average, roughly, probably 12-year Treasury bond averaged 2.13 because it's just a UST bond. I'm sure it's a high, just a conglomerate of 5, 10, 20, 30-year bonds. All right, I don't know, but I'm comfortable enough to do this video and to put my portfolio here. All right, so then we take, we got the percentages. We got to make them not percentages. We got to use their terms of, I don't know what you call it, arithmetic rate of, I don't know what you call it. 1.052 means a 5.2% rate of return. We do all this, and we see from 1946 to 1968, $100,000 invested in the S&P 500 was worth 1.6 million schmackers. $100,000 invested in bonds, basically intermediate, essentially government bonds was worth $160,000. $100,000 invested in 3-month T-bills was worth $175. 3-month T-bills are the equivalent of cash, just FYI. They just change all the time. So I'm very comfortable with that. That's my 3-bucket approach: a third, a third, a third. So you can see that 22-year time frame in the S&P 500, it's so dwarfed the bonds and anything else that in fact Ed talks about this. He says in his article here, if I can find my spectacles, it's a great article, man. Let me pause it real quick. As long as we are condemned to analyze only the entire historical record up till today, we are always going to conclude that stocks beat bonds in any sample that includes 1946 to 1968. Because look, how do you get over this right here? That's such a hurdle you'll never be able to jump over it to show you that bonds ever beat stocks. This is not an argument in favor of stocks. I'm just telling you right now. All right. Your grandchildren would come to that conclusion. Your great-great-grandchildren would come to that conclusion. And your great-great-great-great-great-grandchildren would come to that conclusion. No matter what kind of analysis you look at any time frame, if you include that 22-year time for that subset, bonds will lose to stocks every time. All right. But mathematically, if we only use this entire sample, the current conclusion can never change. It doesn't matter if a more fine-grained analysis will reveal that every century or so, stocks enjoy 1 or 2 decades of outperformance, even if 90% of the time they perform the exact same thing. Because that 22-year time frame was so superior for stocks, you will never have a time where stocks don't beat bonds. It's crazy. In fact, Ed goes into it. It's pretty interesting, too. He says, after 1,085 years of stock and bond parity performance, 5.1%, stocks still outperform as long as you have that 22-year time frame in there. If that 22-year time frame is in there, unless stocks go to zero, bonds will always underperform. It's crazy, man. It's very interesting. In fact, I think he even does something right quick. He says, what if returns were lowered? It's just, I'm not kidding. It doesn't matter. It's nuts. This article is fantastic. This is what I wanted to point out. Does a century of modest stock underperformance suffice to dilute away the outlier? So now stocks underperform bonds, in this case, by 1% a year on average. Nope. 2 centuries, not even 2 centuries. In fact, even if stocks underperform bonds by 1% a year, it'd take 220 years to reach where bonds outperform stocks because of 1946 and 1968 time frame. That's almost 3 centuries. Face it, stock advantage from 1946 to 1968 is never going to fade out of the data. And as long as we must look at only the entire sample, it will always be true that stocks have outperformed bonds, even if no period like that time ever exists again. All right, I hope that makes sense. So what we're doing here is I said, okay, so we're going to separate out. We're going to separate out what happened from 1969 to 1982. Now, a lot of people recognize that time frame as a high inflation, high raising interest rates, whatnot. So right now we got, if we had $100,000 in the S&P 500, is worth $246,000. This is not net of inflation. This is just real returns, or nominal returns, I should say. $100,000 in 1969 is worth $246 in the S&P 500. In 1982, $100,000 in the Treasury bills is worth $275 in 1982. $100,000 in the basically 10-year T-bonds, Treasury bonds are worth $224. All right, so that's pretty close to parity. All right, so then we're going to say, well, what about 82 to 2011? That's the boom years for bonds. Boom years for bonds, because the 30-year Treasury at that point was paying 15 and a quarter, my friends, and it went down to like 2.5 to 3%. All right, so the average, let me do averages here. I didn't do that. So we're going to go average, oops, right there, blinky, 12.3%. But again, 1982 to 2011 was a boom time for stocks, at least for the first 18 years of that. All right, so we had 12.5%. So the stocks averaged 12.3% a year. Long-term bonds average basically, what does that say, 9.66, and Treasury bills average 4.62. All right, so what was the end result? In stocks, if $100,000 invested in 1982 was worth $2.2 million at the end of 1980 and 2011. Cash was worth $383,000. Long bonds was worth 1.3. Interesting, is it not? Yes, it is. Yes, it is. So that's very, very interesting. And I did not do, because we don't actually need to look at the Great Depression era, and we can come over here and we'll just show you, because he has it. He says from 1928, and we'll do it until 1940. We'll just say stocks. How much has he got in there? $100 $100 invested in stocks from 1928 to 1940 was worth $107. $100 invested in Treasury cash was worth $117. $100 invested in long-term bonds is worth $154. You see what I'm saying? So in these 4 different quadrants, we have the Great Depression, we have the boom post-war, we have the high inflation, and then we have the boom, Reagan, Clinton, whatnot. You see what I'm saying? We had bonds beating, stocks beating, parity, and then stocks beating with a lot more volatility. Because if we look at the volatility of these time frames right here, we're going to come down to 1982 right there. Yeah, so let's go down to right here. We're going to look at standard deviations now. And we'll type in blink. Pause it real quick. So from 1982 to 2011, the S&P 500 standard deviation was 17%. The cash was basically nothing, 2.8, and then bonds was high at 10.54. But to get that increased standard deviation, you netted about another $1 million. That's a lot of money. Don't get me wrong. But if you timed it wrong, i.e., 2000 or 2008, you got skunked, dude. There's no two ways around that. And so while you got a higher ending value in 2011 with stocks, you took much higher standard deviations. And again, standard deviation is just a measure of downside. I mean, it's not truly a measure of downside risk, but that's what we use. We say, look, 3 standard deviations would be 51%. So in any given year, you could be down, well, we know what you could be down, 37% in 2008. That makes sense to me. So you're like, dude, were you able to go to sleep at night down 37%, given that you had, higher rates of return? The answer is probably not. Many of us didn't, especially who just retired. So for me, because I'm in a not defensive posture would be going all CDs. I don't want to do that. I'm 52, so I'm not a spring chicken, but I still got many years ahead. I no longer buy the idea of stocks for the long run. I don't, because this article right here, it just shows you, it's kind of like if, they got these charts that say if you miss the top 10 days of the market the last 20 years, you basically had bond-like returns. The same kind of thing here. If you missed the top 22 years of the history of the U.S. stock market, you missed the stock-like returns. Let me rephrase that. If you missed the top 10 days of the S&P 500, your S&P 500 still had all the volatility of stocks, but it had given you like a similar return to bonds. I hope that makes sense. The whole point is time in the market, not timing of the market. And I agree with that 100%. Here, we're saying if you missed the top 22 years of the market, basically since the dawn of U.S. stock market history, bonds and stocks are pretty close to even Steven. Not quite. Stocks have outperformed a little bit because the massive amounts of volatility. That's just a fact. And again, I like growing dividends, so I'm not going to shy away from growing dividends. But I think for me, I'm like, man, maybe cash will be the thing that rises up over the next 20 years. I don't know. All I know is I'm 52. I can't afford to have a market a la 1928 to 1940. And you can't either, my friends. In fact, it's not just 1928 to 1940. I think a lot of people forget we were in a war here. It's literally from 1941. We were in a war, and that war, we didn't know it was going to win right here. And that had ration cards, it had government taking over. I mean, it's a complete fascist state. You see what I'm saying? We had no clue how that was going to shake out. It turns out we won. Did we really win, though? Did we really? Don't even get me started. Werner von Braun. Anyway, but it turns out that we won, but we didn't know that during that time. You see what I'm saying? And I just, the government was able to manipulate things in which to increase returns of corporations because they basically took them over. And you had no other, there was no choice. You couldn't say, I'm going to compete against this as rat. I mean, it just is nuts. So when that was done, though, we were the only game in town, the Marshall Plan and whatnot. We took charge of the world, man. And I don't think we're going to be able to, I think those days are long gone, man. I mean, look at what's happening. All these other countries say, that doesn't mean the U.S. is dead. We're not on our backs. It just means our level of influence is going to be greatly diminished, which means it's going to be hard to see the rates of return from these post-war years that we, right here, look at that. I mean, look at that, dude. Crazy. We're not going to see that. That doesn't mean bonds are the reprieve. Doesn't mean cash is the reprieve. But I want to catch growth in stocks when it happens, but I also want to be protected in cash when it happens. Now I'm getting rewarded 5%. And I still think bonds have more upside than stocks over the next year to two. I just do. I absolutely could be wrong. And if I'm wrong, I'll still take a 3.5 to 4% rate of return on government bonds. That doesn't bother me. I'll take that. Anyway, we'll see. That's my thoughts. Don't forget to come on Tuesday night, 8 p.m. See my man Craig Israelson. I think you get a lot of that. All right, see you. Love to hear your thoughts.